Okay, welcome to the latest installment of our weekly webinar series. I'm Jim Hendricks with Hendricks Wealth and Estate Management. This is the latest in our weekly series of webinars that we've been doing for about a year now. And we've got a special guest today, Rick Litton with Guild Mortgage. So today's topic is financial planning and mortgages, how to be smart. So we'll talk a little bit about what mortgages are, what the common questions are with mortgages, and how they relate to financial planning today. And I've got a series of questions lined up for Rick, so we'll see how he does with those. And we will take your questions as well. So if you've got questions, you can put them into the chat down at the bottom, or into the Q&A, down at the bottom of your screen. And we will handle those as they come up, or if we're really rolling, then we'll save them for the end and see how much time we have at the end for Q&A. But without further ado, let's get rolling. So Rick, why don't you just take a quick second to introduce yourself?
Hi, everybody. My name is Rick Litton. I'm with Guild Mortgage, part of the Hendricks Litton Mortgage team. And I am happy to be here and look forward to answering some great questions.
Okay, so let's get rolling. First of all, just a general question about the mortgage markets. What do you see for mortgages for the rest of this year and then as we head into 2027 or maybe even beyond that?
That is a great question. And anybody who says they know for sure is wrong, but I will tell you what I hear and what Fannie Mae say is predicting. They're expecting mortgage rates down into the lower sixes by the end of this year or early 2027. And in my experience, I would assume that the rates are going to be somewhere in the fives by summertime next year, I believe. And I hope that does come to fruition. So rates were near 5% in early 2026. And then we went into Iran, and it created a lot of uncertainty in the market. So the market did go up. The interest rates went up 3/4 of a point in a lot of cases. So hopefully that trend starts to come back down into the fives soon.
Okay. For people who are just getting into mortgages here, what's the process to get them pre-approved to either buy a home or to refinance?
So the process is pretty easy. For myself, I prefer to do an application over the phone. And the reason is there's definitely some nuance to the mortgage application that might not be picked up if you do something online. For example, income. If you're a salary employee, great, super easy. If you're self-employed, then we have to review the tax returns to determine what the write-offs are and where the actual usable income falls. And if you're hourly, then we have to take a 2-year average. So if somebody applies online, it's a little bit harder to know exactly what the usable income is. So we take an application over the phone, we pull a credit report and run all the numbers behind the scenes, and then we approve you for a maximum amount for a purchase. So if you're approved for 500,000 purchase price, but you're only looking at homes at 400, well, you know you're going to be fine. On a refinance, we take into consideration an estimate of the value, and then whatever you owe, and we determine what type of refinance you'll qualify for. Be it just a rate and term, you're at 7.5 and you want to go to 6%, great. If you want to get a little bit cash out to pay some debt off, that's a little bit different refinance, but we discuss all those options.
Okay. And I know a lot of people are confused by mortgages. So what are the main areas where people do get confused? For instance, what are points and what's the one thing that you'd tell people when they're considering a mortgage when push comes to shove?
When it comes to points, a point is merely 1% of the loan amount as a fee. So you might see something online, interest rate 6.375, 1.5 points. That means they're just charging you 1.5% of the loan amount as a fee to get you that rate. You buying or paying points right now in this market, I tell people that it's probably not the best idea to pay points to lower your rate. Let's take a quick example. The rate's 6.75%, and you want to pay a point on a $300,000 loan. That's $3,000 to take your rate from 6.75, say, to 6.5. And let's say that saves you $45 a month. Paying that $3,000 up front to save $45 a month may not be the best move right now, especially if rates are going to be in the fives in the next 12 months. You'll never make up that money, and chances are you're going to refinance. And with Guild, if we do a purchase for you and the rates drop within 12 months, we eliminate our lender cost when we do a refinance. So that's saving $1,425. So the refinances become very inexpensive.
Mm-hmm. So if in a falling rate environment, then it doesn't really make any sense for buyers to pay points because they're likely just to be able to refinance in the near future anyway.
Absolutely.
Okay. All right.
Correct.
Very good. This kind of dovetails into the next question. What are the costs associated with getting a mortgage and the costs that are generally paid by the buyer?
So there are costs now, and they have increased over the years. Generally speaking, and take this with a little bit of a grain of salt, generally speaking, you can expect about $6,500 in costs. Most of that cost is the title, obtaining the title to the property. That is determined by the seller's attorney. And depending on the purchase price, the higher the title cost might be for the buyer. Anywhere between $3,200 and $4,500 for title. The lender fee is about $1,425 with Guild. You're going to pay the recording of the deed and the mortgage, which is a couple $100. You're going to pay an attorney fee, which could be anywhere from $400 to $700, depending on the attorney that you get. You also pay the first year of homeowners insurance up front. You're always going to be a year ahead on homeowners insurance. So if the insurance is $2,000, that's part of the closing costs. So generally speaking, $6,500, depending on insurance, maybe $7,500 for the buyer.
Okay. And I assume that you like to work with a team of professionals. In fact, knowing you, I know you like to work with a team of professionals.
Of course.
When working on through the lending process. So who are the important team members that you like to have involved in the process?
So the good news with Guild and the Hendricks Litton team is that everyone on our team has at least 20 years experience. We have an assistant who's been in the business for over 25 years, our processor over 25 years, and our underwriting team much longer than that. So it's so important to have a great team when you're doing a mortgage because there's so many little nuances behind the scenes that we have to consider, especially with a condo. We have to get association management company information. We need to deal with the attorneys. We need to deal with the real estate agents. And there's documentation behind the scenes we need to get. So we have that process so down pat that there's no surprises at the end of the loan when you're going to closing. Most everything is done within the first 2 weeks. Then it's typically a hurry up and wait until the closing date comes. So it's very, very important to have a great team.
Okay. And we'll talk about this in a little bit, but where I kind of come into the fray here is as a financial planner, I wanted to get involved in the mortgage process because I want to make sure that from a financial planning standpoint, which is kind of the overarching topic of today's meeting, we want to make sure that people are getting the best deal for themselves for their long-term finances as well. A lot of times people will weigh out the options that are available to them short-term versus long-term. They don't know how fast they want to pay off their debt. They don't know if they should go with a 15-year term or a 30-year term. Again, I'll talk about all that in a little bit. But as part of the team, having a financial planner look at your finances too to tell you what is likely in your best interest in the long run, and to make sure that you're not getting overly charged up front by fees or other things it's just kind of good to have another set of eyes looking at things. So that's where we like to get involved too. Let's see. There's a big question that we get a lot is what is mortgage insurance, and is that something that should be avoided?
It doesn't necessarily have to be avoided, but mortgage insurance is merely a policy that protects the bank in case the buyer defaults on the loan. So if the buyer defaults on the loan, the mortgage insurance company is going to pay a portion of that loan back to the bank. So they're insured. If you put less than 20% down, you're going to incur mortgage insurance. Depending on the down payment, the larger or smaller the insurance will be. For example, if you put 3% down, it's going to cost a lot more per month than if you put 15% down. And it's also predicated on credit scores, the amount of insurance you pay.
And next question is, I know this one used to confuse me a lot before I learned a little bit more about the mortgage business, but when you're talking to mortgage brokers and people in the mortgage industry, they're always talking about conventional FHA, VA. Can you explain what's the difference between conventional FHA and VA loans?
Sure. The conventional loan is a standard Fannie Mae, Freddie Mac, the two governing bodies of the mortgage world, a standard conventional conforming loan that most people do. 30-year, 15-year, 20-year, whatever the term is. FHA is the same, but it's insured by the federal government. So what that means is you could put as little as 3.5% down. And you could also take your debt to income ratio up over 50%, typically to 55%. So that could help you qualify for a little bit more of a home. If you're looking to buy a home at 300,000 and that's your max on a conventional loan, an FHA loan may get you to that 325, 350 that you need for that home that you fall in love with. So it's insured by the federal government, so the bank has a little more protection, so they're willing to take that income ratio a little bit higher. VA loan is for veterans. You could put as little as 0% down, which is fantastic. And if a veteran has disability, 100% disabled, they can avoid paying property taxes in Illinois. And they, depending on the percentage of the disability, they could also avoid the funding fee for a VA loan, which is several $1,000s in many cases. So.
And that can vary from state to state, correct?
It could.
So, all right. So, yeah, our office, we're coming to you live from Illinois today. That's where our home office is in Algonquin, Illinois. We also, Hendricks Wealth and Estate Management also has offices in Bradenton, Florida, and this reaches audiences all across the country. So, but we know a little bit more about the Illinois markets, but in your specific market, there might be different variables that apply to you.
Correct.
Okay, very good. What are the conditions where when somebody might go from a conventional loan over to an FHA loan instead?
Well, it's more typical to go from an FHA loan to a conventional loan.
Okay.
Because with an FHA loan, there's automatically mortgage insurance no matter what your down payment. So sometimes people want to refinance. Maybe they have an FHA loan, their credit score is a little bit lower, so that might benefit them with the mortgage insurance and the rate. And then 2 years down the line, their score goes up to 800. They have more equity. They want to refinance to a conventional loan and get rid of that mortgage insurance altogether. So that's more typical. I have had people go from a conventional loan to an FHA for typically reasons of credit score. Some anomaly happened in their credit, and that's the way that they have to go.
Right. So typically your FHA is going to be something, there's going to be some factor of that loans that have an application that doesn't qualify for conventional. So you have to go as a backup down to an FHA.
Yes.
Okay. All right. Very good. All right. You want to give your contact information and we'll get into a little bit about the financial planning and how that ties into the mortgage business?
Sure.
All right.
Again, Rick Litton. The phone number is 630-319-4762. And you could email me at RLITTON @guild, mortgage spelled out, .net. Okay. Happy to answer any questions and reach out anytime.
Okay, and we'll have you provide that one more time before we're all done here today. But you can always, if you want to get in touch with Rick, you can always get in touch with us too, and we can put you in touch with Rick. Our website is right over my shoulder here, hendrickswealth.com, and you can send us an email right from that website, and we can put you in touch with Rick if you want to do that way. All right, just want to talk a little bit about financial planning and how it relates to the mortgage process, because a big question that people have is what term should I get on my loan? Um, should I be should I be making a big down payment or a small down payment? Should I make accelerated payments on my mortgage? And again, I kind of wanted to get into the mortgage industry to kind of help people with this because believe it or not, how you struck people think your home is your biggest investment that you'll ever make. And we hope that that's actually false for most people because your retirement plan should be the biggest investment that you ever make. But your home is a very important part of that. And if you overcommit cash to your home, that leaves you less to putting into your retirement plan, either in the amount of home that you purchase or the amount of your payment that you create for yourself for down the road. So, for instance, we're generally recommending that people get a 30-year loan instead of a 15-year loan. I know that sounds counterintuitive to a lot of people because you've been told your whole life that your mortgage interest is going to be your biggest expense that you ever pay. But if you think about it this way, when we're investing, I can't really quote returns, but hypothetically, let's say the S&P 500 has averaged close to a 10% rate of return annually over the years for long, long periods of time. It's been pretty close to 10% per year. So if we use that as our benchmark and we could have a mortgage at 6%, I'd much rather see you put $1 towards your investments and earn 10% rather than put $1 towards your mortgage and save 6%. It's much better to make 10. Stock market, this may not be for everybody. The stock market is a risky place. You don't make a straight line 10% every year. There's years where you go backwards. There's good years, there's bad years. But in general, as a lifetime strategy, you're very likely to come out ahead if you're investing money towards your retirement or towards an investment account rather than using those same dollars to pay off towards your mortgage on a faster basis. You might have a slightly higher rate if you go with a 30-year mortgage instead of a 15-year mortgage, but you're going to be coming out ahead because the extra dollars that you're saving in your monthly payment can then be invested and earn an average annual rate of return that's very likely to be higher than the rate of interest that you're paying. This is something that I've been doing in my own personal life for many, many years now. And I carry mortgages on every property I've ever owned. And in my investment accounts, I have enough to pay all those off right now if I wanted to, because I've been disciplined about investing my extra cash to go towards investment accounts over time. So, and that's something that's markets have been generally very, very good for the most part over the last 20 years. Occasional bad year in there. 2022 was a bad year. But overall, there's been many, many more good years than bad years, and that's led to some very healthy returns in investment accounts. And again, that return is very likely going to be higher than what you might have as a mortgage rate going forward. So we generally recommend 20% down, though. So we want to avoid mortgage insurance if you can. So we generally recommend people put 20% down unless they're qualifying for one of these other programs through FHA or VA. And then also extending that term out as long as reasonable, which is usually a 30-year period for mortgages, generally what we recommend. And then once you do have that mortgage, a lot of people, again, they think that the interest expense on my mortgage is the biggest expense they'll ever have. So they get this urge to pay off that mortgage early. We are generally not in favor of that because, again, you've got an opportunity to leverage yourself a little bit and get better returns by taking those same dollars and investing those instead, especially if you can do it into some type of tax-deferred vehicle like a 401k or a Roth IRA. But even if you can't do it into a tax-deferred vehicle, then you're still getting a incremental return, very likely, in excess of the interest rate that you're paying on your mortgage. So we generally look for people to stretch those out over time. And again, where I like to be involved in the process is helping people make the right decisions right out of the gate. And I know Rick and I have known each other since 1989, something like that. So I know Rick's character. I know that when we're working together, I know that Rick's going to get people into the right product, and that's why I chose to align myself with Guild. So if we have any other questions, we will take those now. Rick, you want to give your contact information again?
Sure.
While we're waiting?
Yep. Phone number is 630-319-4762. Email is rlitton@guildmortgage.net.
Okay. And again, you can always go to our website if you want to reach out to either of us. You can reach us at our office at Hendricks Wealth and Estate Management by going to www.hendrickswealth.com. And if you send us an email, we can put you in touch with Rick if you're looking for mortgage information. Again, this is our latest in a weekly series. Every Wednesday at 11:30 Central, 12:30 Eastern, we do one of these webinars. Now, I say we do this every Wednesday, but we're not having one next Wednesday. Our staff is all tied up with an activity next Wednesday, so we will not have one on August 5th, but we will be back on August 12th. My brother and our in-house estate planning attorney and also financial advisor, Sean Hendricks, will be hosting a webinar entitled Estate Planning in Your Retirement Years. So please tune in for that one. Again, these do happen every week at 11:30 Central, 12:30 Eastern. Again, I'm Jim Hendricks with Hendricks Wealth and Estate Management. This is Rick Litton with Guild Mortgage. We does not look like we have any other questions. We'll give a minute for any other possible questions to come in. But if we don't get any, then we will wrap up for this week. And hopefully we'll see you again on one of these podcasts very soon, one of these webinars very soon. And it doesn't look like we're going to get any other questions. So I guess that's it for today. Thanks again, everybody. And we'll hope to see you again.
Thanks for
Bye-bye.
having us.